Welcome back to Unraveling the Jargon, where we decode the complex language of trading. Last time, we embarked on a journey through the maze of trading terms, shedding light on some of the most commonly used phrases. Remember bulls and bears, candlestick and divergence? Yes, that was quite a ride. Today, we're picking up where we left off, continuing to illuminate the path for those of you navigating the trading landscape. In this episode, we're diving deeper, exploring some of the more nuanced terms that you might come across in your trading journey. From Fibonacci levels to fear of missing out, from market makers to market structure, we've got a lot to cover, but don't worry, there's no need to memorize everything. As you immerse yourself in more tutorials and engage with fellow traders, these terms will start to feel like second nature. So, brace yourself as we dive into the ocean of trading jargon. We kick off with FIB levels, a concept rooted in mathematics. Now, you might be wondering, what on earth are FIB levels? Well, they're short for Fibonacci levels, named after the Italian mathematician Leonardo Fibonacci. He discovered a sequence of numbers where each number is the sum of the two preceding ones, starting from 0 and 1. In the world of trading, FIB levels don't rely on arithmetic, but rather percentages. These percentages represent specific levels from swing point to swing point. They are essential tools for traders because they often indicate where price might potentially react or even reverse. Imagine it like this. You're on a hiking trail. The FIB levels are like markers on that trail, showing you where you might need to slow down, rest, or change direction. They provide a roadmap of sorts for navigating the volatile world of trading. So, remember, FIB levels help traders predict potential price reactions. Next up, we have two emotional drivers in trading, FOMO and FUD. Imagine this, you're watching a cryptocurrency skyrocket on the charts. You see people around you making profits, and you think to yourself, I need to get in on this now. That feeling, that rush of adrenaline, that's what we call FOMO, or fear of missing out. It's the anxiety that an exciting or interesting event may currently be happening elsewhere. FOMO can be a powerful motivator, pushing traders to jump into trades without sufficient research or understanding of the market. It's like running headfirst into a storm without checking the weather forecast first. You might get lucky and come out unscathed, or you might get caught in a downpour. The key is to remember that making informed decisions based on data and market analysis is always better than making impulsive decisions driven by FOMO. On the other side of the spectrum, we have FUD, or fear, uncertainty, and doubt. These are negative sentiments or misinformation that can influence a trader's decision, causing them to sell their assets prematurely or avoid entering potentially profitable trades. It's like hearing a rumor about a storm and deciding to cancel all your plans even though the weather forecast is clear. FUD spreads quickly, especially in volatile markets. It can lead to panic selling, causing prices to drop, which can then trigger a domino effect of more fear, uncertainty, and doubt. It's a vicious cycle. And the best way to break it is to stay informed and do your own research. So, when you're trading, it's crucial to keep your emotions in check. Don't let FOMO push you into impulsive decisions, and don't let FUD scare you away from potential opportunities. Always remember, informed decisions are the key to successful trading. So, FOMO and FUD are emotional responses that can significantly influence trading behaviors. Now let's move on to fractal and FTA. Two terms that help traders predict price movements. First up, we have fractals. These are recurring patterns that traders look for in the price data. They are like little breadcrumbs left behind by the market that might hint at where the price could go next. This is based on the assumption that if a particular pattern of price movement has occurred in the past, it might just happen again. Fractals can be bullish or bearish, indicating potential uptrends or downtrends respectively. But remember, while fractals can provide valuable insight, they are not a guarantee of future performance. Next, let's talk about FTA, or first trouble area. This is a point on the price chart where traders anticipate potential resistance or support. It's like an obstacle course for the price, and the FTA is that first big hurdle that it needs to overcome. If the price manages to break past the FTA, it could mean a strong trend is underway. On the flip side, if the price is rejected at the FTA, it could indicate a reversal. The key is to watch how the price behaves when it approaches these FTAs. You see, fractals and FTAs are like two sides of the same coin. Fractals help you identify patterns that might repeat, giving you a heads up on potential price movements. FTAs, on the other hand, help you pinpoint key areas where those price movements might face challenges. But, as with any trading tool, they're not foolproof. They're simply pieces of the puzzle that, when combined with other analysis techniques, can help you make more informed trading decisions. It's all about finding the balance, understanding the signals, and making the best call you can with the information at hand. So as you navigate the world of trading, keep an eye out for those fractals and FTAs. They might just give you the edge you need to stay one step ahead of the market. Remember, fractals and FTAs are useful tools for predicting potential price reactions. Let's unpack some abbreviations that traders use frequently: HH, HL, LH, LL, HTF, LTF. First up, we have HH and HL. These stand for higher high and higher low, respectively. When a price chart is showing a series of higher highs and higher lows, it indicates an uptrend. It's a bullish sign suggesting that the buyers are in control and pushing the price up. On the flip side, we have LH and LL, which stand for lower high and lower low. When a price chart shows a sequence of lower highs and lower lows, it's a sign of a downtrend. This is a bearish signal, indicating that sellers are dominating and driving the price down. Now you might wonder, why is this important? Well, understanding these trends can help traders make more informed decisions. For instance, they might choose to buy in an uptrend and sell in a downtrend to maximize their profits. Next, let's talk about HTF and LTF. These abbreviations stand for higher time frame and lower time frame. Essentially, they refer to the duration of the chart you're looking at. A higher time frame might be a daily or weekly chart, giving a broader view of the market trends. Conversely, a lower time frame might be a 1-hour or 4-hour chart, providing a more granular view. Why does this matter? Well, traders often use multiple time frames to get a comprehensive understanding of the market. They might use a higher time frame to identify the overall trend and a lower time frame to pinpoint precise entry and exit points. So these are shorthand notations that traders use to describe price movements and time frames. Remember, trading is a complex activity that requires a solid grasp of these concepts. But don't worry, as you immerse yourself in the world of trading, these terms will start to become second nature. Happy trading! We continue with more trading terminologies: alike, laddering, leverage, long position. Firstly, LIQ, short for liquidity. Liquidity refers to how quickly you can buy or sell an asset without causing too much of a price movement. High liquidity assets mean you can execute larger trades without significantly impacting the price, making them ideal for traders who want to enter and exit positions quickly. Next, we have laddering. This is a strategy where a trader places multiple buy or sell orders at different price levels to get an average entry price. Think of it as climbing a ladder, where each rung represents a different price level. It's a method employed to mitigate risk, as it allows the trader to spread out their orders rather than placing a single large order at one price. Then there is leverage. In trading, leverage refers to using borrowed funds to increase potential returns on a trade. It allows traders to control a larger position than their initial capital would permit. However, while leverage can magnify profits, it can also amplify losses, so it's a tool that should be used cautiously. Lastly, a long position. This term refers to buying an asset with the expectation that its price will rise. If you're going long, you're essentially betting on the future growth of an asset. But remember, a long position doesn't just mean buying and holding an asset. It could also involve using leverage to increase potential returns. So these terms, LIQ, laddering, leverage, long position, define various trading strategies and market conditions. Each has its place in the trader's toolkit, and understanding them can help you better navigate the complex world of trading. But remember, trading involves risk, and it's important to understand these concepts fully before applying them in your trading strategy. So, these terms define various trading strategies and market conditions. Finally, we look at margin, market cap, market maker, and MS. Let's begin with margin. In the world of trading, margin represents the amount of funds required to open a leveraged trade. Think of it as a down payment made to the broker to explore the opportunities that leveraged trading offers. Next, we have market cap. short for market capitalization. It's a straightforward concept, really. The market cap of an asset is calculated by multiplying the current supply of coins by the current market price of one coin. It's a quick way to estimate an asset's value and compare it against others in the market. Now let's talk about market makers. These are typically large institutions or firms that can cause significant price swings due to their massive position sizes. They play a vital role in providing liquidity, as they are always ready to buy or sell at publicly quoted prices. So when you hear someone say, "The market makers are at it again," you know there's some serious action happening in the market. Lastly, we have MS, which stands for market structure. This term is used to describe the pattern that a market is currently trading in. It's like a roadmap that traders use to navigate the market, identifying trends, potential reversals, and key price levels. Understanding the market structure can provide valuable insights into market behavior and potential future movements. And that wraps up the key terminologies for today, all of which play a crucial role in understanding market dynamics. Now that we've unraveled more of the trading jargon, you're one step closer to becoming a proficient trader. We've navigated through the labyrinth of trading terms, shedding light on the sometimes cryptic language of the trading world. In our journey, we've explored FIB levels, those specific points that represent percentages between swing points, where price often reacts. We've examined the emotional roller coaster of FOMO and FUD, those fear-driven behaviors that can lead traders to make rash decisions. We've delved into the mysterious world of fractals, patterns of price movement that have occurred before and might occur again. We've also introduced you to the concept of the first trouble area, the point where price might be rejected before reaching the target. We've looked at the highs and lows of trading, understanding the significance of higher high, higher low, lower high, and lower low. We've also ventured into the realms of higher and lower time frame. We've pored over LIQ, laddering, leverage, and long positions, giving you tools to navigate the fast-paced world of trading. We've discussed the importance of margin, the funds required for leveraged trades, and the significance of market cap, the total value of an asset. We've also revealed the power of market makers, those individuals or firms that can cause large swings in price. And we've discussed the concept of market structure, the structure that the current market is trading in. These terms, while complex, are essential in understanding the world of trading. They form the language of traders, the code in which market trends and strategies are discussed. With this knowledge, you're well on your way to mastering the art of trading. But remember, learning is a continuous journey. Keep exploring, keep asking questions, keep mastering your craft. As you immerse yourself in this world, these terms will become second nature, your trading strategies will become more sophisticated, and your confidence will grow. Don't forget to like, subscribe, and hit that notification bell to stay updated with our latest content. Until next time, happy trading.